Hello and welcome to Closing Trades right here in ET Now with me, Aisha Faridi. And it's been quite a bit of chop and churn that we've started the week with. Started off just mildly in the green, from there cracked down a fair bit, and now you're seeing a little bit of a pull up. Bajaj Auto, that's one stock which has been holding out quite well. HDFC Bank about 3% higher. Bajaj Auto, of course, indicating that they'll do much better than their peers. Their commentary we will just highlight in just a bit from now in the due course of the show. Crude prices, they seem to have stabilized. 2.25% bump up coming in for Asian Paints. M&M, Eicher Motors have all picked up in the green. Reliance L&T as well, giving due support to the index. What's been cracking down, of course, is Tata Consumer after the disappointing set of numbers and the commentary from the management in the conference call as well. In fact, at one point in time, the stock was nearly headed in for a 9% decline on the futures, currently trailing lower by over 7%. Kotak Bank, a similar state really there, disappointed by the numbers. The street has really hammered the stock, 5% lower, and hasn't seen any rebound since. There's IndusInd Bank also, which is lower by about 3.5%. Trend, it started its decline in the latter part of last week, and today too it's seeing a fall of about almost 2.6 odd percent. 75.92 thereabouts is where the stock is currently. ONGC, Bajaj Finance, BEL, these are some of your other laggards in trade. But let's welcome on board our experts and try and dissect where the market is headed from here. Dhananjay Sinha joins in from Systematics. We've got Kunal Bothra, Naresh Mirani, too, joining in on the show as always. Kunal, let me come to you first. It's choppy, though in a relatively narrow band. Of course, we've seen wilder swings on many other days. But what is it that you're making of the market texture?
Yeah, too much of choppiness, not anything which signals any kind of a trend reversal or a trend coming intact for the indices. So I think we've neither broken below the 24,750 mark on the Nifty. We've not managed to break the 25,000 mark also on the Nifty on the upside, even after a very strong kind of an initial first few minutes of a gap up for both the Nifty as well as for the Bank Nifty. So I think that's the concern for the markets on an intraday basis. We'll just have to wait by for the indices to start signaling some kind of a trend before we look at directions being initiated on the indices. As of now, it looks like a choppy market, and the concern for the markets in the last 5-7 days is not just the choppiness for the indices, but the market breadth, which gets onto a much more higher level of deterioration whenever there is any kind of an intraday volatility. I think that's keeping the traders on the edge. Otherwise, I think it's a market when you look at the indices, which is just about flattish to slight negative.
Okay, that's the take coming in on the index right now. Dhananjay, hi. How is it that you're dissecting the market right now? All those China concerns, I guess, are ebb to rest because we were just culling out the data as to how much the FII outflows have been from both China as well as India month to date. And China is standing at a very, very tall figure still. That arrested, what about the earnings season and the color on them so far?
I think from a market standpoint, it has been a market that has seen a lot of rotation over the last 7, 8 months, I would say, and generally it has been buoyant. But I think over the last, I would say currently, things have become a little uncertain. Quite apart from the fact that over the last quarter or so, there has been some concern with respect to earnings outlook and the economy in general. So I think what is now happening is that while the flows have been a little choppy from a global standpoint, there is a concern with respect to with the valuation, etc. I think what is catching up now is the fact that some sort of negative trend that had emerged with respect to earnings has actually deepened this quarter. So if you look at it, by and large, the consumer space is actually also disappointed, notwithstanding the fact that people had expected a better rural demand. We have seen Dabur that has actually disappointed, and many other companies also. Tata Consumer yesterday came up with a result which basically shows that there is some margin sort of contraction. Other companies are also showing, if you look at the consumer space, they are seeing margin pressure. Companies are trying to ensure that they are ensuring that their market share remains. We have seen in autos, for instance, there is a significant contraction in volume, especially passenger vehicles. There is a rising inventory levels there. I would say commercial vehicle, etc. I think what has somewhat been on the positive side is the IT space, where there is some traction as far as the deal wins are concerned. There is some confidence with respect to BFSI space. That's the common thing that is coming around from the IT space. There is some expansion in margin, etc. So I think there is some select positivity that is happening. Likewise, I would say the pharma sector has actually been doing well because of the churn. People are trying to get into more of pharma stocks. By and large, I would say the banking sector has been under a lot of regulatory, issues with respect to and I think there is a lack of counter-cyclical buffer because of the peak levels of credit deposit ratio, and the banks are struggling on the deposit front. So essentially, for them to sort of scale up their leverage and protect their earnings ratio, I think those are things that are kind of very concerning from a lending standpoint, lender market standpoint. You have seen NBFCs, microfinance showing some rise in NPAs, etc. So I think the choice for the market is actually getting fairly limited. People were trying to, look at consumer stocks that did very well, but I think the disappointing numbers have seen a correction. So I think people are sort of, looking at pharma, ITM, some select names from a market standpoint. So I think it's kind of a fairly choppy market. There is some kind of rotation. There is very wide correction and strong correction that happens when is happening when there is a significant disappointment as far as the results are concerned. So I think that's the broader context of the market.
Okay, so that's a detailed, broader context of the market. We'll discuss those individual sectors and segments in a bit. But first, let me take it across to Naresh. Naresh, today the India VIX has taken a bit of a spike. And while HDFC Bank, Reliance are doing the heavy lifting, and even Bajaj Auto for that matter, on the flip side, it's about IT being under the weather, and then Kotak Mahindra Bank, which is dragging its feet by almost 30 points. Naresh, the question on the markets, I think you'll have to unmute yourself.
So we continue to see this volatility in terms of a day-to-day basis. You have result season. So today, even after an 80-pointer plus positive impact of HDFC Bank, we are at a flat index as such because we have a Kotak Bank, Tata Consumer, or a lot of result reactions being on the downside. So we are still stuck in that band, 24,600, 700 on the downside, 25,200, 300 on the upside. That's the band for the Nifty. And we are not seeing any follow-up price action in any of the names. So overall, we are still stuck in a tight range. At the same time, global markets continue to be positive. So for now, we continue to have a positive bias, but be careful on the result side because what we've seen over the last couple of weeks is more downticks on results than upticks.
Downticks, and today the downticks are very sharp on the likes of India Mart, a 17% cut there. We did speak with the management. They did acknowledge that last 3 quarters there have been problems when it comes to the silver category churn, and they haven't been able to arrest that. They are expecting a couple more quarters of pain really to come through. RBL Bank, wherein there is a bit of a downgrade coming in from a lot of brokerages as well. That stock is down. JM Financials, which is down 8%. Remember, there was actually a positive news with RBI lifting the curbs that it had implemented 7 months ago, but the stock had run up last week itself massively. So today there's a bit of a profit booking there. And then Tata Consumer, of course, under pressure, under the weather with that 7% cut. Before we move forward, let's quickly listen into what the management of India Mart had to tell us, and then we'll put the spotlight on some of the other buzzers.
Growth. I don't think because our ARPU growth has been upwards of 10% in the past many quarters. So I don't think that is a very near-term possibility. But yes, if we are not able to fix the paid subscriber addition in the longer period of time, there could be issues related to that. That this is one of the quarter that we have suddenly had from 15%, 14% to 5% growth rate in collection. So I think we are expecting that to bounce back again to double digits in the coming quarters soon. Why the collection from customers has been coming down from upwards of 20% to lower single digit, lower double digit numbers is probably because of the fact that for the last 5 quarters, now we have been adding net customer addition at a much slower pace of about 2 to 3,000.
Okay, point taken. So that's a view on India Mart consumption. Dhananjay, that you were talking about how the traditional consumption has been on the back foot. We have seen the likes of D-Mart, even Tata Consumer, Nestle report weak set. What does one do with the stock perspective? Does one just stay away from that space or buy in a bit on the dips? What's the recommendation?
So I think we are constructive on the consumption space because I think eventually it's the consumption space that will need to lead the way of recovery. At this juncture, there are many headwinds, with respect to the rural demand, the government spending, etc., has been fairly tight. I think all those things are having an impact on the consumption space, especially the rural areas. I think eventually, people are expecting better second half. I would say the way it will take, I guess people, it will take a little longer because people were too excited about the rural recovery right away after the election. I think eventually it will be driven by margin expansion because what we are finding now is common across consumer space is that people are trying to, ensure that they are not ceding market share to local players. They are ensuring that they are taking the right price action to protect the market share. So in the near term, there is a loss of EBITDA margin for them. But I think eventually, as the margin expansion story plays out with lower commodity prices and raw material prices, I think the larger players will claw back in terms of their profitability, etc. So you'll need to be patient with the consumer names. I would say that sharp dips and sharp reactions that we see with near-term results can be opportunities. So there can be some valuation correction, etc. So I think those things can be looked at because what I think is that eventually the deep cyclicals will see much larger correction, and I would say that in the sector rotation, I would say people will look back at the consumer space eventually. At this juncture, we are more constructive in terms of positive outlook on the pharma and the IT space, which is especially the IT space, which is showing some positive traction in terms of the momentum of various operating metrics. So I think this is how I would put it.
Pharma and IT, you are incrementally positive on those space. Domestic today is down in the trading session 6%. It didn't look like a very bad set, to be honest. The numbers were all right. In fact, there was a bit of an improvement in terms of margins and top line. We did speak with the management and we'll try and get a slice of that conversation up for you because overall for IT sector it has been a mixed set. But the other thing you need to watch out for is the fact that some of these companies have run up 30-40% in the last 3 months itself. Time for a quick break, but as we do that, hear out what the Mastech management told us earlier.
We feel really comfortable in terms of the deal pipeline that we have, and the order backlog will continue to grow as we move forward. So it's in good shape. Q3 has a certain furlough or the holiday impact, but if you take the holiday impact out, with all the long-term corrections that we've taken and the diligence, like I said, that we've put in, we really are also pretty optimistic that margin percentages should go at 70 and beyond. I think in general, we are very comfortable to deliver the kind of margins that we want. It's just that we want to balance between our investments and our outlook on margins. So we feel comfortable reaching 17. That's not a concern for me right now.
No, I don't.
Back with closing trades right here on ET now. It's still Tata Consumer, Kotak Bank along with IndusInd. That's the one which is really weighing heavy on the markets right now. Tata Consumer has barely seen any rebound play out. It's really been down and out from the word go, a gap down, and then hasn't managed to resurrect itself. Still lower by a good 7% almost as we speak. Trent as well, lower by about 3% right now in trade. Kotak Bank, of course, has been languishing, 5% lower there as well. IndusInd Bank too is seeing a cut of about 3.5%. And then Ultratech Cement too, lower by 2% as we speak right now. Bunch of other names which are of course reacting to their earnings. HDFC Bank of course turned out to be a good set. A lot of brokerage reactions coming in. For HDFC Bank's earnings, which came by over the weekend, Macquarie maintains they outperformed, target price of 1900 on the stock. IIFL again a buy, target price 1880, and Novama has also upped the target price all the way to 1960 right now. The board, of course, also approved the OFS of equity of up to about almost 10,000 crore rupees from the HDB financials during the IPO. TechM, the PAT beat was clearly led by the one-off that they saw. For RBL Bank, of course, it was a very weak set. We saw the way the stock gapped down when it opened in trade. About 10% is the kind of cut that RBL Bank saw for itself when it opened for trade. IFL, they maintained the ad though. But they've cut the target price now to 195 on the stock, still languishing, and now a 14% cut is what you're seeing on RBL. For UCO Bank as well, the numbers came out and the gross net NPAs have actually seen a dip down of about almost 14 basis points. There's been an improvement of about 5 basis points for the net NPAs too. PAR has seen an uptick of about 52%, although UCO as well has eased off from the top of the day. Kunal, what's the take on the PSBs ex SBI, and do you see any trade here, or would you say stick by with the private banking lot?
Yeah, in fact, SBI is one of the strongest names so far on the PSU banking lot. Other than that, I think it's Bank of Baroda, which I think is nearing the level of 250 approximately, 247 to 50 is where it's trading right now. So that's another stock which is looking attractive in terms of a breakout. So there are two things which are happening for the PSU banking index. One is that from the PSU banking lot, we've seen outperformance coming out from the large cap to stronger names, SBI and Bank of Baroda. The other and the most important one is that there has been a relative outperformance, or there's been a momentum jump into these PSU banking lot when you look at this comparatively from the 7th of October lows. So at a point when the Nifty's retested the previous lows of 24,750 approximately, the PSU banking stocks have managed to make a higher low as well as managed to break past, some of them managed to break past about the previous swing highs in the PSU banking index. So that indicates that there has been a less amount of selling and sort of more buying into the PSU banking names. So I think in that sense, one could probably expect that the likes of SPI, Bank of Baroda, they could stand to outperform. I have not seen the mid-cap end of the PSU banking charts of late, but I believe that if these large cap names, SBI and Bank of Baroda, they start to move up higher, then I think eventually all the other stocks which have been just about going through a drag over the last 1 or 2 months, they would also start to chug along.
Okay, so that's the way that's the view coming in on SBI and some of these other gainers. But manufacturing as a theme, Dhananjay, what's your verdict on that? Of course, there was that laptop import policy, etc., which was going to get rejigged. So Dixon and Amber were in focus on account of that. Amber today is up a solid 14% at the moment, and some other manufacturing companies as well, whether it's Auto Ames, etc., have been doing well. Do you think large part of this, trade is well discovered now, or do you still see upside on some of these names?
So I think Dixon and all have actually seen some expansion in new areas and all. They have actually announced those kind of expansion. I think there has been a run up in the stocks out there. So I think a lot of it is actually being priced in. The performance of Dixon, Amber, and other such players who are into the electronic stuff. So I think there has been a significant outperformance out there. So I would say that for the manufacturing sector in general, beyond these select sectors, I would say there is fairly intense competition. If you look at with respect to metals, for instance, or even other consumer goods, there has been a good amount of competition that is happening from Chinese manufacturing and all. So I think those things will be there. Look at cement and all. There is a contraction in terms of the EBITDA that has been there. So I think the large manufacturing sector, metals, for instance, a lot of these companies are showing almost like a 30 to 40% contraction in EBITDA. So I think there is a fairly intense amount of competition. Even if you look at chemicals, the chemical sector is also seeing certain amount of fairly intense amount of continued amount of competition from from China. I would say select sectors in the chemical space, especially the those relating to agrochemicals, fertilizer, etc. Those have been doing fairly well. So I think there has been domestic momentum out there. So need to be fairly selective about where the growth momentum in is there when there is where there is limited amount of competition from Chinese imports. I think that's how one should look at it. Look at the manufacturing sector.
The take coming in on the manufacturing sector, but yes, as you pointed out, cement sector is in focus, and Ultratech Cement started, or actually not started, it was Dalmia Bharat which reported a weak set over the weekend, and then Ultratech has followed suit. There's a margin disappointment that has come in, and margin disappointment is something that we have seen across the board for most of the companies this earnings season so far, maybe barring IT a bit. That has been the pain point in this quarter. In fact, let me now take it across to Ashesha to get more details on Ultratech's earning. Ashesha, at one point of time, the stock had nosedived 2.5–3% after the earnings, but it's recovering a bit now. Talk to us about the internals.
Well, absolutely. Revenues are slightly higher than what we were working with at about 15,600 odd crores. But as far as margins are concerned, it has come in as a miss, 12.9% versus expectations of 15%. So it's clearly a miss as far as margins are concerned. Remember, realizations have declined by about 8 odd% on a year-on-year basis and 2.5% on a sequential basis, in line with the fall in cement prices that we have seen over the last 1 odd year. So realizations clearly have fallen, but higher costs have also impacted EBITDA per ton. We were working with a figure of 800 rupees per ton as far as spreads are concerned, and it has come in at 725 rupees per ton. So it's clearly a miss as far as spreads and margins and EBITDA per ton is concerned, but their outlook continues to remain very strong. They believe that they will continue to report volume growth of about 7 to 8% over the next few years. They continue to focus on their expansion plan, so they are eyeing 200 million ton capacity by FY28. So the long-term plan continues to remain intact, but as far as this quarter is concerned, lower realizations and higher costs have impacted performance, and it's a big miss as far as EBITDA per ton and as far as margins are concerned.
Oh yeah, and Ultratech lower by about 1.5% in trade, reacting to those numbers. But Dhananjay, good to have you on the show. Thanks as always for taking the time out. Let me also take in some closing trading ideas as well. Naresh, what's on your list?
So that would be a buy on ICICI Bank. The stock has been stronger on a relative basis and holding on well. So expecting this to keep the leadership status.
What about your closing ideas?
That'll be a buy on Bosch. That's a chart which over the last 2 days has been relatively stable. The volumes have dipped down today for the stock, but relatively I think 36,500 seems to be a very good support for Bosch.
Okay, we'll take a very quick break then on that note. When we come back, we'll have Ajay Bagga as well join in to track the last half an hour of trade this Monday afternoon.
Welcome back. Well, the market is under pressure, 24,773. So after that gap up opening, it hasn't really sustained. We continue to be under pressure. India VIX has taken a bit of a spike today, and individual names are doing well. So Tata Group of companies like Tejas Networks, which is a bit of a result reaction. Sharp increase in the profitability is doing well. Tata Chemicals up 10%. That entire expectation of Tata Sons IPO has put fire under that one, and even Indian Hotels for that matter is reacting to the similar news flow. Bajaj Auto deserves mention, and Crystal post earnings has been doing well. On the losing side, India Mart is down, RBL Bank, JM Financial, Tata Consumer, CG Power, which just reported its numbers, and Mastech Limited, they're all down and out in the trading session. Ajay Bagga also joins us on the show. Ajay, hi, good to be speaking with you. So far, we have seen earnings from select financial, large private banking names, whether it's HDFC, Kotak, Axis, etc. And barring maybe an HDFC Bank, which also was, in line or slightly better, it's I think the HDB IPO, which is providing a fillip to that one, numbers haven't been impressive. What does one do then when it comes to the private banking space? Stay put, increase, reduce the allocation? What next?
I think we have to increase. The good news is they have underperformed, and markets went in quite skeptical about the results. And as the rate cuts come in India, normally you do see a NIM compression happening for banks. But what is working for the private sector banks is, one, market share gains. Second, you will see that the other concomitant booms that are happening, say real estate, for example. So mortgage books of most banks are expanding quite fast. That will be a driver. The corporate balance sheets got cleaned up over the last 5 years. That private capex will come in due course. Maybe a couple of quarters from now, you will see a pickup starting to come in there. So private sector banks are well positioned, select public sector banks as well. But I would say it's time to buy. It's not time to sell at all in the private sector banks.
Ajay, so any spaces so far which are looking interesting either to sell or to buy in this current market now that we're sort of midway earnings season?
Yeah, overall, Aisha, slightly slowing macro, taxes remain high, interest rates remain high. That is a bit of a disappointment on the rates front. And with that, you have FII outflows. So, but we have weathered that quite well. If you look at the markets, they have held up quite well despite the very, record-breaking nearly $10 billion going out of the secondary markets. And we have hardly moved down. Overall, markets were at elevated valuations, markets were at all-time highs. We have come off those, but the story has not changed. That's the good news. And it is a matter of time. I think it will take a few months maybe, but that churn out of a very strong outperforming US market, where the S&P 500 has given 13% returns for a decade, that is going to change, and emerging markets will come back. Emerging markets have underperformed. India has done very well within that, but India remains a very strongly performing macro with good corporate governance and companies which have cleaned up their act to a large extent. So that story stays. Now, right now, what has happened is the market has taken a breather. We have seen FI outflows, but the domestics have been able to substitute those without very serious harm coming to the markets. That's a very positive sign. And when those FI flows start turning, when you have a double-barreled inflow into the markets, you can imagine how fast that catch-up would be. So what we are suggesting is not the time to go out of the markets, because when it recovers, it will be a very sharp, concentrated recovery, and you won't get time to buy at these levels again. From here, it might go down, 3-4% down is 24,000 on Nifty. It looks like a big number, but it's just now 3-4% away. So no big deal. If you go down somewhat more, that will be another good buying opportunity. But the secular story, the structural story is very much on for India. So we have to keep focused on that. And within that, of course, financials, capital goods, the infrastructure rollout that's happening, all those, but at the right valuation. If you recall, defense and railways, right from the budget time, we were highlighting that these valuations have become too high. It will be difficult to make money from these valuations. Those have corrected very sharply. Still, I would say not a buy time on those. We can wait and let some more froth go out, and you will get a chance to come in. But things like financials were, skeptically looked at, and I think now is a good time for the private sector banks, as I mentioned earlier.
Point taken. In the meantime, Tata Consumers continues to be under pressure. In fact, let's hear out what the management had to tell us, because clearly the India business has disappointed. There are those murmurs of additional threat coming in from Camper Coal, etc. The management did allude to that on their con call as well. But hear out what they told us earlier in the day.
Rural has picked up. There is stress on urban. And it is my feeling that food inflation is probably hit hard. That's number one. Number two, there is a significant movement on festival dates last year versus this year. Number three, also unseasonal rains impacts both out-of-home businesses as well as stocking up for salt, etc. So bunch of stuff. Can't point out to anything, one thing specific. That said, October has started off well, so I'm keeping my fingers crossed, saying we will have a good third quarter. Normally, companies carry inventories. So while I'm talking of 30% is the here and now, In quarter one, we were carrying in inventory from the last quarter. Opening this quarter, we were carrying inventory from, again, Q1. So it takes a little bit of time for the pass-through effect to happen. And therefore, I would think ultimately costs will get passed on. But I don't see any other category excepting, okay, so ready-to-drink beverages, there is a new player in town who's trying to play the pricing game. We were late to the party in terms of correcting prices, but that's not to do with the commodities. That's to do with the competitive positioning. I remain confident that Narishko ready to drink, our volumes will come back. But there will be a pressure on margins. The most important things for us to do is get volume momentum back into both packaged beverages and ready to drink. And in packaged beverages, make sure that we are taking gradual price increases to make sure the margins come up to par.
Right. And Ajay, that's the sort of standing out factor, right? Ever since Dabur's Q2 updates and now, of course, the commentary coming in from Tata Consumer, the FMCG segment has been where you're seeing the first signs of a definitive slowdown, if you will.
Yeah, or we can say that despite the inflation being quite strong, you've not seen the value numbers come up. So if you deduct the inflation out or you look at only the volumes, then you know there is disappointment. And we have, Aisha, now we have a scenario where the rural demand is stronger than the urban demand. So the numbers from various retail consultancies that are coming out is pointing towards a 5% plus rural demand pickup in the last quarter, while the urban demand is languishing at about 4%. So that is a bit of a surprise. It is pointing towards that the drag on the economy of very high interest rates, no relief on the GST side, taxes remaining, especially for that segment. When we were talking on the budget time, a lot of commentators were saying that up to 15 lakhs, this makes sense and that makes sense. But if you're really looking at an urban Indian, the amount of tax incidents that is there was expectation that something would be given to them. That kind of a monetary and a fiscal stimulus is really lacking, while prices are going up, and prices on the food side are non-negotiable. People have to eat. The tea, coffee prices going up 19% for tea, 35% for coffee, wheat prices going up, corn prices going up. I think those are really leading to sluggish demand. And we've seen that even in the two-wheeler segment, when one of the two-wheeler majors came out with a 5% volume growth, you saw the sharp corrections in the two-wheelers, because we had really thought that after this harvest season, money will come in the rural economy and that will be the big driver. That is okay, it is tepid, but the urban demand not picking up has been a big issue. Now, with the Diwali bonuses coming in for that segment of workers, which is a large portion of the workers, will get their Diwali bonuses end of this month, early next month. That demand, how that translates, we'll have to wait and watch. But right now, FMCG has disappointed. You saw the MNC FMCG results declared. You mentioned the Indian FMCGs. I think that demand is not coming, and 60% of Indian GDP is private consumption expenditure. So if you have that in a problem, it becomes an issue.
Yes, that private consumption hasn't taken up in a broad-based manner, so that remains a point of worry. But talking about consumption, at least Zomato's consumption seems to have gone up, and especially with the kind of delivery rates coming in from their Blinkit as well. But now let me take it across to Snehi to get a better sense as to what the street is expecting from their Q2 earnings. Snehi, what's the expectation?
Well, yes, if you take a look at what the street is penciling in, largely it's a good set of numbers that we're expecting for quarter two this time around. Let's take a look at these numbers on a consolidated sequential basis. Revenue is expected to grow at 10% QOQ. 4,681 crores is what we're expecting this figure to look like, compared to 4,206 crores that we saw in the first quarter. EBITDA also expected to go up by 20% Sequentially, 209 crore rupees is what we're expecting the EBITDA figure to come up to versus 177 crores. Now PAT, however, we're expecting to see only a 3% sequential growth on this front. PAT is being penciled in at 260 crore rupees compared to 253 crores in Q1, and the EBITDA margin also slight expansion is what we are seeing here at 4.5% compared to 4.2% in Q1. Now, here are some key expectations that we are penciling in for Zomato's numbers. Food delivery, the segment is likely to post 7% QOQ GOV growth. You have strong performance that's expected from Blinkit, because Blinkit is also expected to post 15% sequential GOV growth, and the sequential margin improvement can be expected to be seen in the food margin as well as the Blinkit business. Here are some key monitorables that we'll be watching out for keenly in tomorrow's results. Market share gain or loss in the food delivery business is going to be an important metric to watch out for. Order volume growth in the food delivery business is also going to be another important monitorable. Delivery charges expansion in the food delivery business will be a key monitorable, and near-term EBITDA trajectory will also be important to watch out tomorrow. However, when you should focus to Blinkit, the net dark store addition for Blinkit is also going to be a very important metric to watch out for in tomorrow's management commentary. But well, yes, all in all, a good set of numbers is what we are expecting for Zomato tomorrow.
Okay, that's that on Zomato, but Bajaj Finance as well due to report its numbers tomorrow. So let's take it across now and to Snehi itself, and she tells us about what to expect from Bajaj Finance too.
Well, yes, so for Bajaj Finance, if you take a look at these numbers on a consolidated year-on-year basis, net interest income is expected to go up by 24.8% at 8,980 crores compared to 7,197 crores this time last year. PPOP, which is the operating profit, is also expected to go up 25.3% to 7,310 crore rupees compared to 5,834. Net profit is expected to go up by 14.6% at 4,070 crores compared to the 3,550.8 crores we saw this time last year. Now, based on the Q2 update that's been given by the management, the deposit book stood at approximately 66,100 crore at the end of the second quarter compared to 54,821 at the end of the second quarter last year, which is an uptick of 21% year-on-year. The new loan books has also grown by 14% year-on-year. Customer franchise also stood at 92 million compared to 76 million. So there's some growth being seen on that metric as well. AUM, which is the asset under management, has grown 29% to approximately 3.73 lakh crores compared to 2.9 lakh crores this time last year. Net liquidity surplus also is being penciled in to come in anywhere between that around that 20,100 crore mark. Now, some other key expectations from these numbers: a 10 bips sequential compression in spreads is what we're expecting, driven largely by a rise in cost of funds. We're also expecting cost to average AUM to remain moderate at 3.9%. Credit costs are expected to be around that 2% mark, which was between 1.5% and 2% for the previous quarters. Credit costs are expected to decline 5 bips on a sequential basis to come in around 1.9%. Asset quality expected to remain largely stable. And lastly, stable cost of funds sequentially and better pricing may lead to expansion on the NIMS front on a sequential basis. So this is largely what we are penciling in for Bajaj Finance's numbers tomorrow.
Okay, point taken. We'll watch out for Bajaj Finance. Today, of course, Bajaj Housing Finance will report its numbers the first time since its listing, so it will be interesting to track that one. Kunal, in the meantime, talk to us about some of these big buzzers. On the gaining side, there's Amber Enterprises, which is locked in upper circuit now 20%. And it's Coforge and Persistent Systems both report their numbers tomorrow, and ahead of that, they're down 5%.
So yeah, I think Amber Enterprises, of course, on the back of that news flow for the stock, it's shown a price volume breakout. But even prior to that, the stock was a very consistent kind of a moving chart. So in the last 1 week, 10 days, when the markets, the mid-cap end of the market has gotten a lot more volatile, this has been one stock which has maintained the upward trajectory. So I think from 4,800 odd, when it started off the month of October, the stock has moved up higher. Till yesterday, it was almost at 5,400 levels, and today it's managed to surpass those levels and move towards the 6,800 mark. So it looks like that the stock is looking quite strong, and with this resilience the stock had developed over the last 2 weeks, it just gained on to that on the back of the news flow. Now for the other names which you mentioned, Coforge and Persistent. Now Coforge, for example, over the last 1 week or so, we've seen the stock going into a correction from I think 7,400, 500 levels towards the current levels of 7,200 approximately. My sense is that the stock is looking slight weak on the charts. So approaching the results on a slight negative note, that could probably dampen the mood for the stock over the near term. And we've seen this for the mid cap IT or the large cap IT names, that I think we've not seen any major kind of a breakouts for those large cap IT stocks, even with the likes of Tech Mahindra, HCL Tech, Infosys, etc. But we've seen these stocks going to a profit booking spree. But at least these stocks have not shown any major correction or a breakdown of their longer term moving averages from many of the larger cap names. So my expectation is that potentially Coforge as well as Persistent, they could be a bit more sideways post the results.
Naresh, you think we've seen a definitive rebound now for Asian Paints? I mean, marking it along with the crude movement?
So given the crude movement, yes, looks like, and the stock has been sideways for just too long. And say 2,800 to 3,000 has been a support band for the stock for the last 3 years roughly. We've only seen a few days below those levels in the last 3 years. So looks like a short-term bottom is in place. Do we get into momentum? That looks difficult. 3,300 has been a 3,400 has been a resistance for the stock for the last 3 years. So looks like a range-bound move, and again we go back slowly towards 3,300.
Okay, that's a take on Asian Paints, but time now to take some BTSC trades. Kunal, what's the buy today, sell tomorrow idea?
So Asian Paints is the first stock which I would suggest as a buy. The stock finally seeing some bit of bottom formation around the 200 DMA. So buy with a target of 3150. Stop loss could be kept at 3000. JBK Pharma is the other stock which I would suggest as a buy. The stock completing a bullish flag formation on the daily charts. It's nearing a break of its 50 DMA. So would suggest a buy with 1960 as a target, and stop loss could be kept at 1880.
Okay, point taken. So that's a view coming in. JB Chemicals and Asian Paints. But Naresh, what about your BTSC trades?
So first is a buy on ICICI Bank, which continues to hold on. Stop loss at 1248, target price of 1290. Second is a sell on Siemens, topping out at around that 8,000 previous high levels, has given a follow-up sell today as well. Stop loss at 7,600, target price of 7,200.
That's some of the BTST trades coming in your way. In the meantime, Bajaj Auto, of course, has seen a marked recovery from the session lows. That stock is holding out quite well, and this after its earnings. You've seen about almost a 4% uptick coming in that stock, although it's not quite made up for its losses post the numbers. But still a meaningful recovery is what the stock is seeing, almost closing in with a 450 odd point uptake. Eicher, M&M, these are some of the other auto majors. And Maruti, I mean, one would say hasn't quite fallen, at least managed to finish off in the green. That's where that stock is. And Tata Motors, of course, has had a red day today. That stock continues to languish. But Ajay, how is it that you're dissecting moves within the auto pack? Because there too, at least with the passenger vehicle segment, the slowdown is quite evident.
Yeah, frankly, I was expecting that with the harvest and the festival season, the two-wheeler pack should start outperforming. But the commentary really dampened that enthusiasm, and I think everybody has now become more sobered up on the outlook for the auto pack. So I think we will have a couple of missed quarters in terms of price action till the fundamentals catch up again. Auto was an outperforming sector for most of this year, but now over the last few weeks it has started underperforming, and that is based on sales slowing down. Passenger vehicles, clearly there is a slowdown in the offtake, and it translates back. The premium segments have a limited capacity to keep absorbing. And with the finance coming in, those have been, we have seen offtakes happening, but we have seen now languishing at these numbers, and year-on-year growth is not very strong. So I was frankly expecting two-wheelers to come up in October, November, but the management guidance is not very good. So I think we'll postpone the look at autos for a couple of quarters and watch until you see serious consumption returning in the economy. It will become difficult for these auto stocks to justify their valuations, the exuberance around them, and second, to really deliver the volume growth. That is critical. Margins have been under pressure. But at least if volumes were coming, and now you can see the advertisements in the papers offering very hefty discounts, and a lot of that inventory cleanup will happen because nobody will buy in December a car with this year's stamp on it. People will look at buying in January. So this is the seasonal period where heavy discounting starts happening.
Yeah, that's a fair point. The calendar year changes and that time period does really make a difference. But Ajay, what will be your recommendation for the Hyundai IPO tomorrow? The expectation is it's likely to list at a meager premium of around 80 bucks right now. Two-part question. A, for the people who have got it in the IPO, should they ride along or try and sell tomorrow itself? And secondly, for the people who haven't really got the allocation in the IPO, though I think for the retail investor, it wasn't really too much oversubscription, so they might have got. For the people who have missed the party, should they buy afresh tomorrow?
Now, we just spoke about auto, Anisha, and I would not like to talk on a particular stock, but I think passenger vehicles, we just spoke that it is sluggish. And overall, the autos are not priced at any discount. So we are giving a very high premium to Indian auto companies overall. So not a time to buy is what I would say. And frankly, with an IPO, we normally wait and watch because the kind of listing in froth that comes in on the SME and the other segments. This was a very huge IPO. Of course, I think nearly 100% allocations, allotments will come on the retail or the NII segments. Anybody who applied should get. The 2% subscription 2 times was more because of the institutional last minute picking up. So I think people will get a fair share of allotments. The grey market is not showing much of excitement. So there will be disappointment tomorrow. But overall auto, I think, is struggling, and we can give it a buy for now. Go for the financiers. I think those are well discovered, and the financiers might do better, especially the private banks.
And Sajid, great to have you on the show. Kunal, Naresh, we'll let you guys go on that note as well. Let me hand it over to Snehi for the closing trades.
Well, absolutely. Let's take a look at quickly how we've wrapped up today's day. Nifty, a 100-point cut coming in on Nifty 50, and we're going to be ending below that 24,750 and very likely below the 24,800 mark as well. But let's talk about Sensex in tandem with the Nifty, but slightly performed better than the Nifty. In fact, just a 0.2% cut coming in, but barely holding on above that 81,000 mark. If you take a look at the broader markets, no show of strength coming in from the broader markets today. In fact, deeper cuts coming in from Nifty mid-cap, almost 2% down, 1.7% downtick coming in. Nifty small cap also 1.6% lower. So it was the broader markets that were underperforming the markets today. Quickly take a look at some sectoral moves then. You have a Nifty auto, that's the only sector that's holding on to the green. Otherwise, your losses are being led by Nifty metal, realty, IT, FMCG, PSU Bank, Pharma, Energy, Nifty Bank. All of these indices in the red. Quickly talking about some stocks that were in focus. HDFC Bank, good set of earnings, good brokerage notes coming in. Tata Consumers was ailed by a poor set of brokerage notes, very bearish notes coming in on India Mart as well. That stock also did not do well at all in today's trading session. You had Raymond Lifestyle though on the back of brokerage notes. That stock did pretty well. Zomato is going to be a key one to watch out for because you have the numbers coming tomorrow. The same for Bajaj Finance, and you have RBL Bank also on the back of a poor set of brokerage notes, a bearish notes coming in, and a poor set of numbers. That stock also did not do well at all. Almost a 14% cut coming in on that stock as well. And the same for MRPL, weak numbers, and Motilal Oswal has also reiterated sell. But that is how we are shutting shop for the day. You have Nifty on the chart, 24,741, sub that 24,750 levels at least is what the chart is reflecting, and that is how we've ended today's trading session.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.